Good afternoon, everybody. I'm very happy. It's a great pleasure on behalf of the Euro-Mediterranean Economists Association to welcome you to another session. This is our third session of the IMF and the Center of Middle East for Economics and Finance for this joint research webinar series. So this, just to remind you, the joint initiative between the Center for Economics and Finance of the IMF and EMEA aim to bridge this cross-cutting edge academic research and evidence-based policy making for, in fact, improving the knowledge on what is happening in terms of the global trends and also impacting the socioeconomic and financial models that we are facing nowadays in fact, most pressing macroeconomic and challenges facing our global economy. And there are a few nowadays that we are globally experiencing. So today's topic is really very timely and will help us understand many trends, economic trends that are impacting our economic and macroeconomic frameworks within our region. So we are clearly living unprecedented challenges nowadays, an era of profound geopolitical and geoeconomic fragmentation. And this is clear within the frameworks that we are seeing, and this is really impacting our traditional macroeconomic framework. So just to name some of the challenges that nowadays we are clearly experiencing, ranging from the rising trade tensions, the regional conflicts and wars, particularly in the Middle East, that they are not entering into the normality, but then we can see that these are impacting clearly our value chain, global value chain, in terms of the pricing, the access, the availability, but also on the fiscal pressures for all the countries that we are seeing. Of course, this has tremendous implications on the real economy, on the quality of life of people, and also beyond this, on our, I would say, infrastructures, education, health, and so on. So also, we cannot leave aside the climate-related shocks. This is very clear nowadays, and also the heightened uncertainties that are all reshaping our global economic and social landscape. So these are really very important matters that we need to look at as economists and really model them in our thinking going forward. So the challenge that I see facing policymakers is not simply how to respond to these shocks. They have to respond to these shocks, but how to build a sustainable, resilient model while safeguarding the sustainable growth, also fiscal sustainability and social cohesion. We need economic stability for social cohesion, and this is essential going forward. So against these conditions that we are living nowadays, this is not theoretical conditions, we are all living it. The paper today is not theoretical. I think this is really in the heart of this topic, and it is titled Global Fragmentation, Fiscal Policy and Economic Growth Across Country Analysis, that really provide a very relevant and timely contribution to the challenges that we are living nowadays. The author has a unique covering of 121 countries between 85 and 23, and the paper examines how geopolitical fragmentation affects economic growth, productivity, public debt, and equality, while assessing the role of fiscal rules and monetary policy institutions in mitigating these effects. So really, this paper has a very important contribution And really, it goes beyond the economic cost of fragmentation. So it's really core into how we can design really credible fiscal frameworks that are essential for our region, but beyond our region. And also, it's important also to think about this interaction with monetary institutions, how fiscal policy and monetary policy can interact, and then they provide what I call a buffer for economic resilience to preserve, in fact, the fiscal space and support more inclusive and sustainable and resilient growth. So I think this paper is important for our assessment of how macroeconomic framework should look like in the future in extreme cases where we are living those shocks and challenges. So it is really a great pleasure to introduce today Professor Ghazi Salahuddin. He's a professor at the Linköping University in Sweden and also member of the Norwegian University of Life Science. I met Ghazi some time ago in Istanbul, and it was really the work that he's doing on these matters is really essential to inform policymakers, to inform the institutions on how really to reframe or to improve and to evolve our macroeconomic economic framework. So he's an economist, and his research focuses on macroeconomics, international finance, monetary and financial and fiscal policy and economic growth. So he has published in several international journals, and he has made significant contributions to understanding the interactions between macroeconomic policies, financial stability, and global economic shocks. So together with his authors, he will present the findings of this important cross-country study, and this will inform us, in fact, on what should be done going forward. So before I give the floor to Professor Ghazi, and thank you very, very much for joining us today, and it's a great pleasure to see you. I would like to give the floor to the team of the IMF, Rashid, to give us some logistical information. And then the webinar will conclude with the director of the IMF Center, Sami Ben Nasser, my dear friend. So thank you for being with us today. And Rashid, the floor is yours. And then afterward, the floor to Professor Ghazi. Thank you very much.
Thank you, Professor Rehman. Thank you, everyone, for joining us today. My name is Rashid Sbir. I'm senior economist and resident advisor at the IMF CEF located in Kuwait. I am really delighted to moderate today's research webinar on global fragmentation, fiscal policy, and economic growth. I will share with you some housekeeping note. This event will be recorded. The recording will be available along with the presentation on our website, cef.imf.org, starting from tomorrow. At the end of the presentation, we will have a Q&A session. You can post your question in the QA chat box. Please do not forget to indicate your name, your institution, and your country. Researchers are invited to submit a full draft to one of the colleagues, Zuhair Salhi or Sandra Shalita. You will have the exact email in the blurb. Without further ado, I'm thrilled to give the floor to our speaker, Professor Ghazi. Professor Ghazi, the floor is yours.
Thank you so much, Professor Reem. Very detailed and very nice introduction about the topic. And also, thank you so much, Rashid, for the details of the seminar. And I also like to give the special thanks to Professor Sami, giving me the opportunity to share our paper in this session. So before start, let's start with sharing my screen and all these technicalities. is it full screen? Am I correct?
Yes, beautiful.
Perfect. So the title of the seminar, or the title of the paper for today, is the Global Fragmentation, Fiscal Policy and Economic Growth, a cross-country analysis. The project or the paper is joint collaboration with Ang from the Goethe University, Frankfurt, Naoki University of Reading, Dong-Hyung Park, current director of the Macro and Monetary Policy at the Siasan Center, and today with me also John Brain from the Asian Development Bank. So I will give a short, like a more presentation about the paper and try my best to discuss details about the topic. And also I'm more interested in looking for your comments and remark after the presentations, and also feel free to communicate with me related to the paper, and the full version of the draft is already available at the SSRN, also the CSM website. So I move to the second slide. So one of the main key motivation of this study, I think one of the key motivation already addressed by Professor Reem very nicely before starting with the seminar. But what I would like to share this topic is very important, as we can observe that after the decade of global integration, the world has a witness of significant geopolitical fragmentation in recent years. For example, the Russian invention to the Ukrainian war, the Middle East war, and which is also decline the global institutional democracy issues, which is also impact on the political fragmentation. And in recent years, if you can observe based on this figure, the geopolitical fragmentation index that we are considered in this paper, which developed by Fernandez in 2024, which is clearly shows a steady increase in the global fragmentation index since the global financial crisis in 2007 and 8. And also geopolitical event, which is starting from particularly from the Brexit, the global COVID-19 pandemic, also the trade conflict restricted the international trade and the financial mobility, which is clearly observed in the different factors of the global fragmentation in the right side of the graph. And while you can observe that global fragmentation is classified in the 4 different subcategories, such as trade, financial, mobility, and political. And all summed together, it's clearly observed that the first order concern for both academician, the policymaker, or the institutions are facing the challenge how the macroeconomic policy can minimizing the impact of global fragmentation risks or global geopolitical risks. So in the next slide, you can clearly observe that in the red line plotted the median debt to GDP ratio among of our sample of 121 countries. And the blue and the green line shows the trend for advanced economics and the emerging and developing economics based on the definition by the World Bank and classification. And you can clearly observe that in the panel A, the debt GDP ratio increased substantially since the late 2000s and potentially due to the fiscal stimulus and following the financial crisis and the global pandemic COVID-19. Plus, the military expenditure increases during the war period of time and lower economic growth due to the supply chain disruption. And it gives the indication that the lack of fiscal discipline lead to the negative macroeconomic consequences, and which is raises the sovereign risk premium, also increase the borrowing cost and limit the government capacity to increase spending during the crisis period of time. And also that also summarized that the limited fiscal space, which makes the country become more vulnerable during the crisis period of time, and which has more stronger impact on the fragmentation risks. So, and in this situation, we can clearly observe that fiscal rule, in particularly the budget rules, are increasingly popular policy tools for the fiscal authorities to constrain the excessive spending, also increase the fiscal space. By credible committing the stabilizing the primary balance, the fiscal rules lower the sovereign risk premium and stabilize the macroeconomic economy. And in the panel B, you can clearly observe that fiscal rules in 1985, a 5% country had a fiscal rule, but it has significantly increased or substantially increased to 97% by 2023. And that also gives the clear indication that fiscal rule and the fiscal discipline can play an important role during the crisis period of time, and the crisis which is more linked to the geopolitical risks or fragmentation risks. And based on this discussion, our research paper are particularly highlighted the three important questions. What are the dynamic, macro, and fiscal effects of fragmentation shocks? The second one, do fiscal rules mitigate the output losses and debt dynamics? And third one, what is the role of fiscal monetary interaction in dealing with the fragmentation? I would like to maybe a little bit make it clear that the difference between geopolitical risks and the fragmentation shock, there is a certain difference. As we know that geopolitical risks that has been widely discussed in the literatures and in terms of the measurement is measurement which is fundamentally based on the terrorist attack, war, and other sort of elements. But in terms of the fragmentation risks, it was not only captured to the war and other, it also captured to the global geopolitical risks plus global trade dispute. Also, it related to the other economic, financial, and other related risks. So global fragmentation risks is computed based on the more than 19 factors, and they're computed based on the principal component analysis to identify the index. On the other hand, geopolitical risks is computed most likely on the war, terrorist attack, trade related component. Just to give a short introduction, the difference between geopolitical risks and the global fragmentation shock or global fragmentation, geopolitical fragmentation risks. And both of the index for the research perspective, we are not computed by ourselves any of these index. Both of the index are actually available by the respective researchers. So we are using the index in order to explaining of our research questions. And the data set is also both geopolitical risks, global fragmentation risks are available in their respective website. So in order to address of our research questions, our panel data is consist of 121 countries between 1985 to 2023. And we apply state dependence local projection methods, which is developed by Jordan 2005 to explain the shed light of the fragmentation risks. And we use the global macro fiscal and productivity effect of the global fragmentation risks. And also we're looking for our main contribution of this study is actually contributed to the fiscal monetary interaction can play an important role during the high level of fragmentation period of time. And in practice, we already know, just give a little bit refresh, in standard theory suggests that fiscal sustainability is maintained in a countries with monetary dominance, since the inflation targeting forces the fiscal authority to stabilize the primary balance without increasing the debt. While we show that in this study, the benefit of fiscal rules is actually mitigating the geopolitical fragmentation risks, and it is naturally to ask whether this effect is amplified under the monetary interaction, for example, like high central banking dependence or the inflation targeting or the flexible FX market. And what we can find based on our investigation, the effect of geopolitical fragmentation risks on medium run output, productivity, and debt mitigated in countries with both fiscal rules and higher central bank independence, and suggesting a complementarity between these two. So I like to repeat it again, that during the geopolitical fragmentation risk period of time, we clearly observe in the context of output, in the context of productivity and sustainable debt management, in a group of country, that country has a better fiscal rules as well as higher central bank independence. So these are the two components are created some sort of buffer to mitigating the risks. So in my upcoming slide and presentation, I will mostly discuss about on these issues. So in terms of our main findings, if we can discuss the review of the main finding that we find in our study, the rise in fragmentation has a contractionary effect on the real economy, and which is also the fiscal sustainability in the medium to long run, and which is defined as a macro fiscal effect. The second, it also dampen the productivity and reduce the income of a poor people disproportionately, which is explained by the development effect. And third one, the presence of fiscal rules helps to mitigate both effect. And finally, having the fiscal rule with inflation targeting, such as floating exchange rate, monetary policy, and higher central bank independence also help to mitigate both effects. So these are the clear messages of our findings. Okay. Let's go to the literature based on this current study. So in terms of the literatures, we classified in the three broad areas. The number one is the fiscal policy and sustainability. The second one, fiscal monetary interaction. And third one, the productivity and unequal effect. In terms of the previous literatures, already discussed a lot in the literature, the fiscal policy and sustainability. So in this paper, we are mostly focused on the fiscal framework to dealing with the fragmentation risks. In terms of fiscal monetary interactions, that's already been also literature highlighted the importance on these issues, but we are looking for, or we are trying to measure the fiscal monetary interaction empirically dealing with this fragmentation. And third one, the productivity and unequal effect, we focus on the implication of the fragmentation risks on productivity and the income distribution of the household. So it is interesting to mention, so in this study, we didn't anything to contribute in theoretically. So it's a very strong empirical exercise, and we try to use based on our previous empirical findings and previous empirical literatures to explaining the fiscal policy linked with the sustainability, fiscal importance of the fiscal monetary interaction, and also we try to looking for the global fragmentation risks impact on the productivity and unequal effect. All right. So in terms of our baseline model, our baseline model is based on the local projections approach, which is developed by Jorda 2005. And this paper actually addressed the macroeconomic implication of geopolitical fragmentation risks and the role of fiscal rule in mitigating them. And we use the fragmentation index, which is constructed by the dynamic hierarchical factor model by Fernandez et al. In 2024 as an exogenous shock in our study. So in here, we are using the fragmentation as an exogenous shock in our model, and we use YIT is the set of our main driving, main variables in our analysis, which is in GDP, which is included the consumptions, investment, and so on. In this study, we're using the set of control variable, including real GDP, real consumptions, real investment, inflation, government debt to GDP ratio, real effective exchange rate, current account to GDP ratio, and weeks, oil price, and so on. So our state dependence by interactions are mostly focused on fiscal rule, exchange rate regime, and central bank independence to obtain the conditional impulse response function using the local projection state dependence approach. All right. So all the data set is a public data set. And in here, one of the important things, thanks to IMF to develop the fiscal rules, IMF fiscal rules data we are using in here, and geopolitical fragmentation index developed by Fernandez in 2024, and all data is available in the public domain. And most of the macroeconomic data we are using from the Muller 2025 et al. 2025, their database, macroeconomic database, and disaggregated public spending data we are using for Gothin 2024, and income distribution data for World Inequality Database, Financial Market Index, Financial Development Index. These are the data are extracted from the IMF database, and the implied volatility index are extracted from the Fed. All right. So now we're looking for the first impact, the macroeconomic effect. So in fragmentation shock lead to a persistent recession, can be a growth or debt problem simultaneously. So if we can look about this impulse response graph, which is clearly indicate that 0.1 point increase in the fragmentation increase, we find a recessionary effect of fragmentation within a set of countries. And real GDP drops significantly, as do the consumptions and investment. And in the line of literatures on business cycle, investment tend to respond more than to the consumptions, because we observe that a rise in GDP, a rise in the debt to GDP ratio, despite the decrease in GDP, suggesting the volume of sovereign debt increases significantly, which is undermine the fiscal sustainability in the medium to long run. So if I would like to interpret of this result, it explains that geopolitical fragmentation increases the debt to GDP ratio via increase the fiscal expenditure and decline in economic growth. And also the increase in sovereign risk premium and cost of borrowing limit the fiscal space to increase the expenditure in crisis. And the lack of fiscal discipline and combined in the disruption of the supply chains and financial transaction probably lead to more persistent drop in output, consumptions, and investment. Yeah. So now if we look at the development effect from the perspective of the long-term growth through the total factor productivity. Total factor productivity, as you know, that it is play a very important role for the sustainable medium to long-term economic growth, and which is very particularly important in the context of developing and emerging economics. And it is also important in order to maintain the fiscal sustainability. However, in this graph, we can clearly observe that there is a negative effect on productivity, which creates the alarm for us, which is probably another more challenges to the policymaker about the long-term economic growth. So this negative impact on the total factor productivity give us challenges for the long-term economic growth, and that indicate that probably an increase in the geopolitical fragmentation lead to the contractionary effect on the real economy, as well as significant rise in the sovereign debt. Moreover, the drop of the total factor productivity poses another threat of long-term economic growth, which could be worsen the fiscal sustainability problem. So now we are interested to see that this is the current scenario. You already observed that due to the global fragmentation risks, we have an impact on GDP, we have consumptions, investment, and the debt to GDP ratio. And the next, we also clearly look about the total factor productivity, which has a very strong impact on the long-term growth. Now, our interest is during this situation, whether the fiscal rules can play an important initiatives to mitigate the risk. So in this study, we are actually using to the IMF fiscal rule measurement, and then we try to looking for, by interaction with the monetary instruments, is it create the more buffer or minimizing the global fragmentation risks. So now we get the first steps that we clearly observe that global fragmentation shock has a strong impact in economy, also consumptions, investment, and total factor productivity or long-term growth. So we try to develop right now state dependence analysis for the fiscal rules and monetary fiscal interaction. So first case, we try to looking for the fiscal discipline or the fiscal rules. In case. So in the equation one, the first equation one explaining the state dependence with fiscal rules. So you can see that DFR we are using in a country, that country has a fiscal rules, no flexible exchange rate. DEX, E for exchange rate, using the country has a flexible foreign exchange market, but no fiscal rule. And D interact with the fiscal rule with exchange rate one is explain that the country has a fiscal rule with flexible foreign exchange market, zero otherwise. And then next equation, equation number 2, we are looking for the state dependence with fiscal monetary interaction. So in this case, DFR is equal to 1, which is explained that country has a fiscal rule, but the central bank independence is lower than to the median or zero otherwise. And CBI, central bank independence 1, that means CBI is higher than to the median, no fiscal rules. Then we interact to the D fiscal rules, interact with the central bank independence 1. That means this country has a fiscal rules as well as higher central bank independence than to the median. So these are our specification to look about the first case. We're looking about the country has a fiscal rule. Does it that country has more mitigating the global fragmentation risks or not? The second case, we interact with the fiscal monetary interaction, and we are interested to see which is create the more buffer to mitigate the risks. I think I would just like to share with you, probably many of you are familiar with the fiscal rules, just for getting an idea. What does it mean by the fiscal rule that was developed by IMF 2025? So in here, we define for the fiscal rule is basically classified in the 4 different categories: debt rule, budget balance rule, expenditure rule, revenue rule. And we are indicated one means in this given studies, we are not looking for disaggregate component of the fiscal rules. We are only looking for if any of this component is implemented by any of these group of countries, then we identify the country has a fiscal rule. So our study, basically, we are using the cross-country analysis, which is based on the panel of 121 countries, including the 34 advanced economies and 87 emerging and developing economies. And we use this type of rules and definition basically only for that any of the rule is implemented in our case. So we are not looking for the disaggregate component of the rules, because we try to capture our studies as much as many countries in the context of developing and emerging economics. And then we're looking for the central bank independence. And you can see that in this graph, clearly indicated by Romeli, 2024 developed the central bank independence, which is clearly indicate that there is an increase in recent decade for both advanced and emerging economics, and also high debt to and it's if you look at from compared to in 1985 from compared to 2023, we clearly observed that central bank independence are receiving high level of importance and also increasingly independent over the period of time. Okay. So now our first case to shows our result that the first equation, we had included our local projection approach with the state dependence. The country has a better fiscal rules. In this graph, the red line is explaining the country with the fiscal rules, and the blue line is explaining the country is without fiscal rules. So you can clearly observe that global fragmentation shock are mitigating with the presence of fiscal rules in both macroeconomic environment and fiscal sustainability. So you can see that fiscal rule mitigated the output losses and also the debt accumulation. So you can see that the fiscal rule has a more important initiatives in during the global fragmentation period of time in compared to without fiscal rule any of these countries. And then in terms of, if you look at the total factor productivity, we can, if you can see that where the fiscal rule also affect the long run productivity growth beyond the stabilization of the macroeconomic environment. And if we based on this graph, you can clearly observe the fiscal rules have a significant mitigation effect on productivity level, and their dynamic responses mirror those of output and investment. And also intuitively, investment as the key input of the into the research and development, and fiscal rule which mitigate decline in investment also help to reduce the effect on total factor productivity. And this is in the line of literatures which is called learning by doing, and the recent literature of the long run effect of some policy tools. And in terms of the income distribution, you can also observe that the first decile of the poorest household are become the mostly affected of the global fragmentation shock, and also it is more, they are also become the more beneficial for this process. Then we move to the interaction term. So in this interaction term, we are introducing the monetary and fiscal interaction through the exchange rate regime. So what the blue line is explaining the country has no fiscal rules or peg FX market, and the red line, the country with the fiscal rules interact with the flexible foreign exchange market. And we can clearly observe that in this like blue line shows the response of the countries. As an example, the blue line shows the response of a country's neither fiscal rule nor independent monetary policy that we explaining as a fixed exchange rate. And the red line shows the response of the country with both fiscal rule. Both fiscal rules means among the four rules, any of the one rules they implemented, we define they have a fiscal rules. And independent monetary policy, which is defined by the flexible exchange rate. And the result shows that both independent monetary policy and fiscal rules significantly mitigate the effect of fragmentation risks, and suggesting a complementary between monetary and fiscal policy tools. And the ability to conduct this type of independent monetary policy provides an additional tool for the central bank to mitigate the risks, and these effects go beyond the real economy. So the key policy implication based on these findings is very insightful, which is that a combination of the fiscal rules and independent monetary policy, which is measured by floating exchange rate, substantially mitigated the negative effect of fragmentation on medium to long run growth in output as well as in the productivity. So that's the most interesting insight that we observe, that during this global fragmentation period of time, the interaction between fiscal rules with the independence monetary policy play a very important role for to mitigating these types of risks. So in order to check these findings become more comprehensive or more robust, we're looking for another way to looking for the fiscal monetary interaction through the central bank independence. And in these cases, when you're looking for the central bank independence, the blue line shows no fiscal rule and central bank independence below the median. So we are using, because central bank is an index, so we're using, if the central bank independence for given country is below the median, we are assuming that has a low level of independence. And the red line shows the country with the fiscal rules with the highest level of central bank independence. That means the central bank independence index is higher than to the median. So in this graph, we can clearly observe that the economy are perform better in reaction to the fragmentation risks in the presence of fiscal rule under the central bank independence, which is defined by above the median. So this is a very important insight that the global economy or the global institution need to thinking about, that the central bank independence or independent monetary policy plus the implementation of the fiscal discipline or the fiscal rule are very important when the global economy or global different countries are facing high level of fragmentation, shock, and risks. So this is the time we really getting the insight that these are the instruments, these are the achievement of the monetary policy, and the fiscal rules play actually a very important role. So in terms of output, if you can look about on the impact response in slightly more under the severe under the high central bank independence with fiscal rules, but the gain in the medium and long term significantly outweighed the initial cost. And we also observed that there is a significant stabilization on debt to GDP ratio on impact on despite the higher GDP, suggesting a small increase in the volume of debt itself. And this is highly relevant, confirm the conjunction that weak central bank independence can also affect the fiscal sustainability negatively. So in combination, all these things, we can say that higher central bank independence, fiscal rules helps to mitigate the medium and long-term productivity, and in addition to output, and also importantly, total factor productivity. This is very important, I said, the most important part for the particularly in the developing and emerging economy. The total factor productivity recovers quickly, even increases in the long run compared to the baseline result. The reason I highlighted, because most of the developing countries and emerging countries are trying to achieve their long-term economic growth, and in order to achieve their sustainable development or many other economic progress and prosperity. So this rule, both fiscal and monetary interactions actually play a more faster total factor productivity and also increases total factor productivity increases in the long run in compared to our baseline result. So that indicates the central bank independence play a complements the fiscal rule, enhancing the medium and long run output and productivity. There could be a challenging issues. I think most of you probably are interested to know that how should we deal with the identification strategy, as the issues are very probably interact to each other. So we conduct an alternative identification strategy using best two steps. The recent paper developed by Bilal and Kajik in 2026, published in the Quarterly Journal of Economics, they using the local and the global climate shock on the issues. And we use their approach to extract the innovation part using the Hamilton 2018 filter. So what we did, the fragmentation that we are using, that fragmentation minus alpha head plus beta head fragmentation T minus H to keep going on. So in the second stage, we regress the innovation term fragmentation that we generated from the Hamiltonian process and set the three set of exogenous shock, and which is extract from the residual as our identified shock. So in here, we identify that our result could be influenced by within the same time, other sort of shock. We extracted it. For example, the oil supply shock by Kajik in 2021, oil demand shock by Bernstein and Hamilton. Second, the military news shock. And fourth one, monetary policy shock. So these are the shock we extracted from our fragmentation shock as well. And after we did this alternative identification, we are clearly hold with this result that fiscal rules still play an important role, same as it is in the real GDP, real consumption, total factor productivity, as well as it's also the government debt to GDP. So that's actually hold our result so far. And in addition with this study, we also looking for disaggregate component of the GDP. You can also the gender impact, which is also very important. Also, we are interested to see that whether the global fragmentation create the challenges to the Human Development Index, which is computed based on the income, education, and health, and also the gender equality index. So we can already see that has also contributed to the mitigating the risks. In addition with that, we are looking for three components of the output: service sectors, manufacturing sector, and agricultural output. And we clearly observe that agricultural output probably is not much affected in compared to the service sector, because we know the global fragmentation labor mobility was become highly disturbed. So that's why service sector has a more stronger position of the fiscal rule compared to the other sectors in the economy. So what are the main conclusions or the key messages of our paper? So the fourth key message is the fragmentation shock are contractionary. They reduce the real GDP, consumption and invest, and also weaken the total factor productivity, which is lead to persistent deterioration in the fiscal sustainability, and which is indicated by the higher debt to GDP ratio in our baseline result. And then fiscal rules mitigate the adverse effect. We found that the country with a fiscal rule experiences smaller and less persistent decline in activity and productivity, and more content raise in debt to GDP. The third one, we also observed that the fiscal monetary interaction, is it matters? Yes, our answer is very strong. It is matter, because the buffering role for fiscal rule is strongest under the independent monetary policy, such as which is proxied by the flexible exchange rate and higher central bank independence. I repeated these findings as a message of this key message of this paper, that fiscal monetary interaction, is it matter during this fragmentation period of time? Yes, our question is it is matter, because the buffering role of fiscal rule is strongest under the independent monetary policy with higher central bank independence. In terms of the heterogeneity and distributional effect, we look at the several heterogeneity analysis in the context of developed and emerging economics, where we are using the different institutional setting, such as lower political stability, higher corruptions, more climate exposed versus less climate risk countries. We clearly observe that fiscal rules help to preserve the key spending categories and reduce the distributional fallout over the medium term. So in addition with this study, we also look at some of the regional study as well, some sectorial GDP component like government expenditure, real education expenditure, environment, real health. We're also looking at advanced and emerging countries, the difference between, and we clearly observe that emerging countries are become more beneficial under the fiscal and monetary interactions, also with the fiscal rules as well. And also we're looking for the high political stability versus low political stabilities. Also, we're looking for high corruptions versus low corruptions, and high climate risks versus low climate risk countries, and also the income distribution. But in here, I just like to give a special attention, as our study and seminar is based on the Middle East and Sub-Saharan African region, I really like to highlight it that Sub-Saharan African region with fiscal rules, the global fragmentation risks will be more strongly mitigated to the another country. And this result also hold in the region for Middle East and North Africa. So you can clearly observe that fiscal rules are playing a more important role in the Sub-Saharan Africa, which is become more stronger and than any other geographical region. And on the other hand, this result is also hold in the Middle East and North Africa, but magnitude is lower than to the Sub-Saharan Africa. So I would like to stop now in here, and probably I'm interested looking for more questions and queries, and any of you have, I'm happy to answer in based on my understanding. I sincerely thankful to the organizer who are inviting me or to giving me the opportunity to us to sharing our paper and finding. I hope the finding of this paper is very insightful from the policy context, in particularly emerging and developing countries. Thank you so much for listening.
Thank you, Professor Ghazi. Excellent presentation. I have a few questions. We'll start with the first one. How do fragmentation shocks affect economic outcomes in advanced economies compared with emerging market and developing economies?
So if you look at my maybe I can show you the graph. 1 minute, then you can. So if you can clearly see that the effect is contributing more stronger in the emerging country, and you can see that if I compare it between the emerging countries and the developed countries, you clearly get an idea that why emerging economics or developing countries are more strongly affected to the developed countries. One of the important things, if you look at the fiscal rule as well as the central bank independence, developed countries are already far ahead in compared to the developing countries. And that's why they probably didn't get the more stronger benefit, because they are already mitigate the shock because they already has implemented. But in compared to the emerging economies or emerging developing economies, you can see that the effect is become more stronger. So fiscal monetary fiscal rule implementation, in addition with the central bank independence and independent monetary policy are more important to implement it in the emerging economies in order to mitigate the global fragmentation risks.
Excellent. We move to the second question. What are alternative identification strategy did you use to mitigate concerns about reverse causality?
I think this is a very challenging question. If you're asking me my honest opinion, did you fully clean this? I think it's in macro. Again, it's totally my personal view. It's not my co-author's opinion, and not my institution as well. So I feel macroeconomy are become so much integrated and so much linked to each other. So it is very difficult based on the secondary data to develop a very, someone can claim is a very clear identification. So what we are thinking about this during this fragmentation period of time we are looking for, there could be a couple of things are important. So one important, demand and supply side of the wild shock, that could be create a problem. So second one, the military shock due to the war, that there is a loss of expenditure. And fourth one, the monetary tightening, that's actually called the monetary surprise. So these are the fourth component we try to extract it from our fragmentation shock and to see whether this result is hold or not. So that's the alternative identification, which is fundamentally motivated by Bilal and Kazak in 2026 in Quarterly Journal of Economics paper to initiate it on these issues. But if you're asking me, I was very honest with you. Did you think it is like 100% solved of your identification? I don't like to claim on this point.
Excellent. The third Third question, what are the distributional effects of fragmentation on household income?
Actually, this is a quite interesting, I think I would like to show you. We have a So I think if you can look about this graph, is quite actually interesting. In here, and the P1 is the lowest quantile of the poorest people, and P10 is the richest people, like in a society, just thinking about in terms of the income distribution. And you can clearly observe that during this global fragmentation, this sort of period or geopolitical risk period of time, the poorest people are the most affected one. Like the most poorest people are become more strongly affected one. So in that case, the rich people like P10, P9, you didn't see the much effect. So the poorest quantile like P1, this is the poorest income household of a group in a issue. So these people are become more strongly affected, and we can clearly see that the fiscal rules or the fiscal initiative actually supported of this group of people. So that's the most important insight on this study, because many of the developing countries, this support is badly required.
Excellent. I have another question, which is, I asked this question a couple of years ago. So the question is, when you consider fiscal rules, do you only examine their existence on the in the paper, or also look at their implementation? And before giving you the floor, I remember, let's say 10 or 15 years ago, I had the discussion with the deputy director of the fiscal affair at the IMF, because this IMF database was missing many Arab countries. I didn't find any Arab country in that database. And I was at that time working at the Ministry of Finance in Dubai, and we had clearly a fiscal budget balance fiscal rule. And before that, I was working at the Ministry of Finance in Bahrain, and we had in the constitution a debt ceiling of 200 million Bahraini dinar, but they were not existing in the database. So how did you overcome this missing data or information about fiscal rule in our region?
I think your question is very interesting and very narrow down. And you probably observed that when you're looking for the fourth fiscal rule is basically based on the four important components. I just go to the slide just in order to help to the audience, make it much more. Yeah. So fiscal rule, basically that's Rashid said, like budget rules, debt rules, expenditure and revenue rules. So if I looking at all these rules, the point you raised, I missed lots of sample in our study. I didn't capture much of the developing countries. So what I did in here, if a countries among the developing or other countries, if they implemented any of these rules, not necessarily that four, any of these rules implemented, then we consider as implementation of the fiscal rules. So this is the issues. And if you're asking me, what would be the case if we are looking for the country has a better, more component of the fiscal rules to implement it? Does it has more stronger impact? We didn't do it this exercise yet. But I did personally many exercises when I did my hobby to look about one of the important rules. But again, this is, I don't have the result, but I have a rough result. If some of you are claiming it, just for my personal exercise, just to share with you. Among these four rules, I particularly find the budget balance rule are very important for the inclusive development for developing countries in compared to the other, because these are the rules play more significance in terms of the fiscal rule impact in compared to all rule is important, but I observed that statistically the numbers is more significant only in the budget rules.
Okay, thank you so much.
This is one of the limitation also. We are only looking for just a fiscal rules. For if any of these rules the country is implemented, either debt rule or budget rule, we put it one. So we didn't classify whether the country are mutually exclusive with the 2 rules or 3 rules. No.
And I may share some on-field observation. Many countries have this budget balance rule when they when they build the budget, but when it comes to the execution, they deviate from the balance. So it is there, but practically it's not implemented. It is there for the construction of the budget program, but when it comes to execution, they have always extra budget from here and there to adjust the balance. Now I'll turn to Professor Reem. I think she has a wonderful question, but I think you need a private meeting to answer all the questions. So the first one, many countries today face an increasing defense spending, climate adaptation needs, digital transformation, and demographic pressure. How can government reconcile fiscal discipline with the need for large strategic public investment? Should fiscal rules evolve to distinguish between current expenditure and productive investment?
Should I go for answer? Yeah.
Yes.
Okay. So I think I didn't study on these issues in empirically, but I'm just sharing my insight of these issues. I think the country definitely need to give the importance regarding the implementations of the productive investment, because the productive investment is required for the country or more developing country in order to create more employment opportunities. So I would like to give you one example that, for example, is my observation, like country in Bangladesh. We have a large numbers of populations in Bangladesh in a small geographical area. So, and Bangladesh is also more climate affected country. So if you can thinking about that, the country where they need to be more focused on it, I would strongly recommend that country definitely need to be focused on more on the productive investment, and that productive investment can create more employment opportunity, and that employment opportunity could be more impact on the overall economic growth and prosperity. And also that also has an impact on the through the current expenditure on the fiscal rule, discipline, and efficiency. Good governance are also be linked in this context.
Great. Another important question from Professor Reem. Fiscal rules appear to generate larger benefits in emerging and developing economies than in advanced economies. What explains this result? I think you gave a brief during your presentation. What lessons does it hold for MENA and African countries seeking to strengthen fiscal resilience?
Yeah. I don't know. I think one of the challenging point, I think you use the resilience. So I'm little bit also the interpret of this word carefully, because this is a very challenging word for fiscal resilience or economic resilience, because I would like to also always, sometimes I challenges my work also myself. So is it the country, I think that I just sharing personal of my view, is it the country has become more implementation of the fiscal rules, or is it the country has become more fiscal resilience during the crisis? So that could be also an alternative questions or alternative study. Is it the country has become more fiscal resilience? They are more tackle this global fragmentation shock is more efficiently in compared to country are less fiscal resilience. So that's actually one of the interesting research question, but I don't have exact answer for these issues for the resilience perspective. But what I have the answer now based on, I actually meet with 2-3 days before in Rashid asking some question for Mina, do you have any result? And I did in the morning this exercise based on his advice. And I found that the MENA and African countries could be much more beneficial to implementation of the fiscal rule. So if you can asking, what is the starting point that MENA or other African or Sub-Sahara. Particularly, I like to give the attention of my statement that I found in the today morning, my exercise, that Sub-Sahara African countries could be much more beneficial by the implementation of the fiscal rule in order to mitigate the risk. So if you look at the benefit among the group, among the region, Sub-Sahara Africa country should be much more beneficial for this implementation of the fiscal rules.
Thank you, Prof. Ghazi. The next question, how can government improve policy credibility where institutional capacity remains limited? Are fiscal rules sufficient?
So in this study, based on this question, institutional setting, I looking at the three important components that probably due to the time I didn't discuss on it much details. So I'm looking for three important components in terms of political stability, which is very important to hold these things. 1 minute, just. Like political stability, you can see that the country have become lower political stability versus higher political stability. You can also can see that high corruption, this low corruptions, and also these are the two, and also the government structures, or that these are the three components we're looking for the institutional perspective. So we clearly observe that the institution play an important role, but the interesting insight is, if I remember correctly, the country has a weak institution. By implementation of the fiscal rule, they are become more beneficial in compared to the country already has a good institutional structure. So the impact is, if a country are more weak institution, they probably get more benefited by implementation of the fiscal rule in compared to the country already have a strong institutional structure.
Ghazi?
Yes. Yes, so that's my takeaway for the institutional side. Yeah, I think we have today. Okay.
You discuss this point. Also, the next question, you discuss different setup where there is fiscal rules and central bank independence. And Professor Reem question is, how should fiscal and monetary authorities coordinate without undermining the central bank independence?
I think this is a very challenging question because even the wording also become challenging. Is it the interaction? Is it what should we say? So I think I don't have actually a very strong answer or opinion because on this particular point, I think no, actually I don't have any strong, but because I just look about their interaction could be helpful, but how they can interact because central bank is one way we are talking about independence. So how they interact to each other, is it, I don't have any actually strong opinion or institutional settings opinion on this because it's linked to, again, the country's settings of their government and all these institutions. Institutional is more related to probably to other domains. So I don't know how should I respond on these questions.
Very diplomatic answer. Congratulations. Yeah. So the next question, do you see fragmentation becoming a structural constraint on innovation, technological diffusion, pursuing green industrial policy, and overall long-term competitiveness rather than simply a cyclical shock?
I think I didn't thinking about is a more cyclical shock. I think this fragmentation can also change the structural settings of an economic. It's very my personal opinion, like structural settings of an economic development. The first of all, couple of important things I really looking for my understanding that after the global fragmentation, the world has a certain things are changed. That number one, the global supply chains payment system also changed. modern digital currency and other sort of things. Also, the global what I call like FX market or foreign exchange reserve management, also little bit rearrange with the adjustment of the gold reserve and other related component. And so I would like to say that global fragmentation changed the innovation as well as technological diffusion, and probably little bit I would like to say it's little bit changed the preference of the country based on their needs. So earlier, like global industrial policies shifted from one domain to the another domain based on the country overall the development strategy. For example, we follow on it like a development strategy in Asia, such as like in Japan and Korea. We also follow to the other countries. I think this strategy could be changed. Many countries could be go for more innovations rather than to the science, medical, rather than go to the defense innovation, as an example. So many countries could be go for more technological diffusion to more like different types of competitiveness. But the challenging point is whether this sort of competitiveness of the fragmentations, whether it creates that reducing the inequality in the globally, it creating the more employment, it improve the life expectancy in the global household, more nutrition intake to the children. That part I'm little bit facing the challenging. So what I feel it, after the Second World War II, the global economy has a significant achievement in terms of reducing inequality, increasing the life expectancy, all the prosperity that we observe. I think the recent global fragmentation shock create the challenges, and that challenges lead to our trade dispute, tension of the free flow of the goods and services and the labor mobility, and also increasing the inequality, and many cases our poverty also be increases, and many people are vulnerable over the period of time. So that's my concern. So global fragmentation definitely can shift it lots of innovation, more technology, but it is important to know what type of technological innovation. This technological innovation is the more destructive technological innovation, or more innovation lead to the more prosperity for the household level. So that's my concern.
Prof. Ghazi, I have remaining like 20 questions. We will not have time to answer them all, but I'll suggest our participant to contact you directly if you have time to answer those questions. But one last question from Professor Reem, which is really important and concern us as advisor to policymaker. If you were advising finance minister in MENA region today, what would be the three most important policy priorities emerging from your research?
I like to give it three important policy. The first important policy is that the country implemented the fiscal discipline. This is the first one. Number second one, even I interact to in terms of central bank. Before the central bank interaction, I would really like to say that institutional quality is required, no matter you implement a fiscal rule or money. And third one, the central bank independence, central bank autonomy for implementation of their monetary policy. So I give it three important components: fiscal rule implementations or fiscal discipline. Second one, the institutions that are really mandatory in order to implement the fiscal rules. Because we sometimes implemented the fiscal rules in terms of paper, but when it goes to the implementation, I think Professor Rashid already mentioned it, it's sometimes very challenging. So implementation is very important. And in order to implementation of the fiscal rule, you need a strong institutional settings that the institution can play an important role. And third one, I would like to say that central bank independence, which is defined by the flexible exchange rate policy or higher degree of central bank independence. Central bank need to be work on independently in this context.
Great, and completely agree with that. And the credibility of fiscal rule, relies much on the institutional framework. And I can give you an example. If you see this fiscal rules database, you will see that fiscal rules are implemented in different kinds, in some countries in the constitution, in some countries by law every year, in the budget law, and in some country like Norway, it's implicit. Different government implement these fiscal rules without any, law, or it wasn't written anywhere. But they discuss it. They found that this fiscal rule is really important for the to safeguard the local economy from overheating using the windfalls from oil. So different government implement the same fiscal rule without any reference. Thank you so much, Professor Ghazi. Excellent paper, excellent presentation. Now I have to
John,
give the floor.
Do you like to add something? Just I'd like to ask my collaborator, John.
John, yeah. John, sorry.
No, I think you've done an excellent job, Ghazi, with the presentation and dealing with very interesting questions. So thanks a lot for these questions by the audience, and myself and Ghazi will take a close look at these after the seminar, and certainly they will help to enhance the policy relevance of our findings. So thank you very much.
Thank you so much. Now we give the floor to our director, Dr. Sami bin Nasser. Sami, the floor is yours.
Thank you, Rashid, and I would like to congratulate Ghazi for this great presentation and very inspiring. So there's a lot of questions here and a lot of interactions, and I learn a lot. So I think and I think it summarizes it very well at the end. I think you need to have good institutions. So that's the most important thing, and also autonomous central bank, but autonomous fiscal also institution that manage the fiscal policy. It's very important to have the means and be autonomous and not dependent on the government to be able, I think, to implement good fiscal rules. So that is very, very important. So I would like also to thank Reem for this joint initiative, which is really great to make sure, I think, our community in Africa, but also in the Middle East, learn about the most recent, I think, breakthrough research in that matter. So thank you, Reem, for this great collaboration I will have, I think, and thank you also, Rashid, for moderating this great seminar. So you did a great job, and we have maybe thinking of extending this because you have so many questions left not answered, but I think Ghazi will be interacting with the participant and try to answer the question later on. And I would like also to thank, I think, the Kuwaiti authorities and the KIA in particular for providing us support to have this center for the Middle East and North Africa. So that's very, very important. We are grateful for that. And I would like also to let you know that this seminar will have been recorded and will be available in the CEF IMF.org, but also available in the EMEA website. So if you have time, you can revisit, I think, this presentation and try to think again. I think this is really a very timely kind of topic and with a lot of policy implication that would be very useful for central bank, but also Ministry of Finance to look at if they want really to make it effective to get protected from this global fragmentation. So I think a lot of insight here. So thank you very much, and looking forward to a new kind of webinar on research in the region. Thank you, Ghazi. Thank you, John. Thank you, Rashid, and thank you, Reem, and see you next time.
See you. Thank you so much. See you soon.
Bye.
Bye. Bye.